And Hale, take two.
uh,
Let's see if we can get this right this time.
okay,
Um,
go for it, man.
so uh, we're giving information, inside joke to the audience. This is our second recording. Hale and I have already recorded this. Did not come out well from a video standpoint. Just had trouble getting audio and video to sync. So we're doing this again. Today, we're going to be talking about captives, and this is Hear It from the Pen. So, this is a podcast from the Yellow Book Road where we talk to authors in the something that's linked to insurance that wrote their own book. And we're going to be talking about this particular book right here that Hale created. So, Hale, we allow everyone to do a little bit of an elevator pitch. Who is Hale Stewart?
Hale Stewart is an attorney. I'm a fifth generation attorney. So that basically means that after I die, I'm going straight to hell. I know this. Okay. I've been practicing in the area of captives and alternative risk transfer for the last 15 years. In 2010, I wrote a book called U.S. Captive Insurance Law, which is still a leading text in this area. And that's been my business calling card ever since. So during that time, I have designed, managed, closed, shut down, and defended in IRS audit captive insurance companies, both small and large. I'm currently the captive development officer with Higginbotham Insurance. And in my little area of HIG, I build and design group captive programs that are unique to our structure. So basically, it's just building group captives as we know and understand that specific concept.
Yeah.
So that's a short version of who I am.
I'm curious, what attracted you to captives?
Interesting concept. An interesting question. Um, Captives combine a lot of things that I like. Okay. First of all, legally, it's entirely transactional as opposed to being court or court based, right? So there's a lot of paperwork involved, and I happen to like that a great deal. Contract law. Before I was a lawyer, I was a bond broker, so I was involved with fairly complex finance. While I do not have a formal MBA, I call it a street level MBA.
MBA of Hard Knocks.
MBA of hard knocks, right? So all those things kind of add up into why I specifically like this area. If you had told me 30, 40 years ago that I'm going to wind up building insurance companies for a living, I would have laughed myself silly. And yet here I am.
Yeah. So I learned about captives very early in my career. They immediately sounded cool. Like,
They are.
whoa,
Yeah.
a company can start its own insurance
Mm-hmm.
company. And yet years went by before I got to learn about them. And I
Mm-hmm.
think one of the reasons why we do these series is to expose insurance professionals who have never been exposed, which in which strangely hail in the captive land is most insurance professionals.
Mm-hmm.
They, you get to some level of seniority, you know what a captive is, but then it's just details, right? Then it's just like, you don't know the trade-offs. You can't speak intelligently to your client about captives. And usually you have to pull in an expert, someone like yourself, to come in and kind of do all of the due diligence. So you've written a book. I think because you're an attorney and now a second author that you might be insane, technically insane for going through this again. Why the second book?
Well, about 2 years ago, I went back to actually I went to my first STICA conference, the Captive Insurance Companies Association, and this was the first post-COVID conference where everybody said this really feels like a true captive conference or
Mhm.
convention. While I was there, I had a couple of agendas. One was that I was with a law firm that was defending companies in 831B audits. So obviously, developing clientele was a key issue. But a second agenda, which was okay, how is the insurance world coping with IRS scrutiny? What specific path, what specific structure are they looking for as a way to kind of countermand this attack from the IRS? Well, there I learned that 831A pure group captives were going strong, going well. In fact, because of the hard market, that area of the market was just growing by gangbusters. So the book was really a way to synthesize a lot of what I knew, both legally and from an insurance perspective, to explain to people, to going back to the point that we made earlier, to explain to brokers who don't know about captives, if you have a larger client who is sophisticated enough to understand risk financing and have their own risk management program, here is how you can put together that specific company.
Yeah.
Where my book differs from the other books that are on the market, and there I'll happily call out a couple of authors. Don Riggin wrote a book that's available on captives. Catherine Westover wrote a book on captives. Ermi has a really good risk financing book. But where mine differs is that mine is the first to not only look at the underwriting process for a captive, which is the middle 2/3 of it, but the bookends of my book are about the tax law issues. Now, something to remember is that in building an insurance company, you are building a transaction that has tax law ramifications. Okay, and that's because there's an entire section of the tax code, pardon me, specifically devoted to insurance companies. So you have to comply with tax law. Okay, so the first chapter of my book talks about the importance of developing an appropriate business purpose, and the last part of it talks about risk shifting and risk distribution as those concepts are understood in the tax law. And now the middle two sections of my book, if you've been involved with underwriting, you've seen most of it before. It's possible that maybe I have a new angle on it that you haven't considered, but the raw material is the same.
Yeah. Before we jump into the nitty gritty of the book and of captives, you brought up the tax implications.
Mm-hmm.
Captives that have been unsuccessful, in your professional opinion, if you were looking at the split of what caused them to be unsuccessful, would you say the tax ramifications are likely the biggest thing that
Mm-hmm.
can bite you, right? Like everyone sort of thinks of the underwriting and those aspects of it, but to me, every time I see issues with captives, it's usually around the tax thing and not necessarily that the captive failed. They had a bad actuarial assessment. The underwriting was poor. I'm sure that happens, but I
Mm-hmm.
almost predominantly see tax issues as the number one, I'll call it bugaboo.
Yeah. First of all the losses, all the recent losses deal with an election called the 831B tax election. Okay. Most insurance companies are taxed like insurance, like standard corporations. They're taxed under Section 11 of the Internal Revenue Code, 21%, flat across the board. 831B is an incentive built into the insurance tax code that is supposed to encourage the formation of smaller insurance companies. And that's where a lot of these issues are popping up. Going back to what you said, in the sales literature, in the presentations on these specific captives, the promoter talks almost exclusively about tax benefits, and they talk about utilizing this election as a way to get a tax benefit. There are issues with the underwriting. That the underwriting is questionable. Actuarial valuations for premiums are typically skewed higher. Also,
more conservatively.
No, higher. And the reason why is that they want larger deductions because what 831B says is that if your premium volume is below now about $2.6 million, you're taxed on your investment income instead of your premium income. So to use an example, let's suppose that in 1 year you have $100,000 worth of premium, but you earn $10,000 in investment return. For tax purposes, in that situation, you would use the $10,000 of investment income as your gross income instead of premium income. So the idea behind skewing these premiums higher is to just get a lot of money into the captive that's basically tax free. And that right there is where the problem that's a problem.
I see.
Another issue has been lack of claims. Most insurance companies have claims ratios, higher claims ratios, right? Here there are few, if any, claims. The claims procedure is very soft and questionable. Basically, these companies have wound up being operated more like a mutual fund with an insurance add-on, right? And just overall, that's been the key problem with
Yeah.
those specific transactions.
Yeah. So this isn't a podcast to introduce folks to captives. I'll put in a couple of links for
Sure.
folks to get that, but I'm going to give a TLDR. Captives are commercial entities that form their own insurance companies to form their own, to retain more of their risk and their tax
Mm-hmm.
benefits and other stuff to
Sure.
it. Um, they've been getting a lot of attention lately, right? So in this hard market with really global insurance capital being squeezed, you're seeing premiums going up,
Mm-hmm.
which is forcing retentions anyways. The economics around it seem to have been quite beneficial. Can you
Mm-hmm.
talk about just the environment that's kind of led us
Sure.
to this particular moment? Why is it on people's lips that in some ways, Hale, some people are talking about it. It's like I'm surprised who's talking about it. So I don't know if that makes it like a counter position, like maybe
Mm-hmm.
this is the top of the market because some of these folks are talking about it. But why is the market so hot?
Okay. Let's go back, I don't know, 3, 5, 6 years. Okay. We are currently in the middle of a hard market, meaning that insurance premiums are increasing at a very high rate. Underwriters are tightening capacity. So, why is that happening? Let's look at that from two perspectives. On the property side, the answer is very simple. It's because the frequency and severity of especially windstorm events are increasing at a very high rate. Okay, so if you live, say, from the tip of Texas all the way up the East Coast and you own commercial property, you're seeing a lot more hurricane activity. Okay, and that's increasing payouts. So as a result, property underwriters are tightening capacity and terms. On the property and casualty side, you're hearing a lot of talk about what are called nuclear verdicts.
Yeah.
So what that means is that a case goes to trial, and the case the plaintiff wins the case, but the jury awards exponentially large, hundreds of tens of millions of dollars, hundreds of millions of dollars. There are lots of reasons for that. Part of it is the fact that the plaintiff's bar is actually populated by very talented attorneys. Part of it is the fact that plaintiff's attorneys are going to go to court with just great, from their perspective, good fact patterns. And the other is that juries tend to look at insurance companies suspiciously. So the plaintiff's attorney kind of plays into that dislike of insurance
Mm.
companies. So as a result, you have very large jury awards, and that's constraining property and casualty capacity. So insureds are getting their renewal notices from their brokers, and they're seeing, even if they're a really good risk, right? They have a
Yeah.
good claims history, no claims history. They're getting renewal notice of like 20, 30, 40%. They're like, wait a minute, I'm not filing claims. I have a risk manager. I'm controlling everything. Why am I seeing these increases? And that's when the sharp insurance producer is going to step in and say, look, here's the deal. There are a lot of events that are happening beyond what we do. I mean, basically, this is just a matter of wrong place, wrong time. However, there is a way that you can, at minimum, gain more control over this expense on your income statement and a lot more insight into how premiums are computed and how risk is priced in the market. And that's a captive. And here's how that process works, et cetera, et cetera.
Yeah. It's amazing how many professionals don't understand how insurance pools work
Mm-hmm.
and how you don't have to have a claim for your insurance premium to go up. There's a lot of variables affecting it.
Mm-hmm.
Interest rates, global reinsurance costs, your peers. If your peers are filing more claims,
Yep.
insurance companies are going to think that you might be next, kind of thing. So my understanding of captives, Hale, going way back, is when I hear about them, they've predominantly been in the following spaces. They've predominantly been workers' compensation, auto, medical malpractice, and I think stopgap health insurance is considered a form of a captive. So those are more casualty
Hmm.
liability associated lines of business, right?
Hmm.
So you brought up wind and you brought up
Hmm.
Texas, and I do not hear about property going into captives. And as a property, as someone who thinks of themselves as a property expert, I view captives as like um, highly forecastable for
Hmm.
property. I almost see catastrophes as being in between traditional property and casualty. How come there has not been any sort of, how come I haven't seen it? Maybe you have seen it. What am I missing
No, you haven't.
around?
There are a couple of issues there. And first of all, in everything you just said, let me jump back. Very brief history of captives. Your question actually has two questions in it, which is a very brief history of captives, and then the split between property and casualty and property captives. So very generally, captive insurance starts in the 1950s because industries are either pushed out of the market or the insurance industry says, we're not going to underwrite this risk anymore. Um, the leading industry there is the oil and gas industry. If you think the oil and gas industry is the Wild West now, take away 70 years of safety developments and innovation and kind of that explain that idea, right?
Truly.
Now, lots of industries are looking at it, right? In answer to your question about why is it that you've heard it primarily for P&C instead of property, um, that requires a very brief explanation of the way insurance is generally priced. Okay, most P&C insurance is priced top down. So what happens is the actuarial department of an insurance company takes macro level industry data and they come up with a premium, a base premium for a company that's a member of a specific SIC code. And the underwriter does debits and credits to adjust that premium depending upon the risk profile of the individual company as expressed in the underwriting application. With a captive, then we'll attach expenses to that for running the captive. And then we'll attach a profit margin for that. But the difference here is that it's a very specialized transaction tailored to the individual risk profile of the insured. Now, on the P&C side, what we really like in the captive world is predictability. So what we're almost always underwriting in the captive world are the lower level of risk. Okay. We're talking about the frequency level claims in workers' comp and auto and GL. Okay. So these are claims that because the company is so large, it's not a matter of if, but when they have claims. Okay. So these are the claims that we're going to pay for in the captive. Now, turning to property claims are very, very different. First of all, in comparison, especially say a workers' comp type of underwriting situation, we just don't have nearly as much data from the property perspective. Okay. So if we want to do a bottoms up approach, we don't really have the same just size of data pool from which to pull our information. The other issue is the short tail of property. So let's suppose I put together a captive program for a property, for a commercial property, right? And I want to take a $500,000 retention. So I set the captive up on January 1 of year 001. Well, 6 months later, I get smacked with a giant windstorm hit, right? So suddenly my captive, which has only been funded for 6 months, is looking at a max payout claim. That's and you know, it's not going to take the claims professional long to come up with a final value for that claim. So I get hit with a big claim up front and the claim becomes fully valued pretty quickly. That right there is the big problem from a captive perspective for property. So compare that to say a workers' comp situation where, yeah, most of my low level claims are easily paid for, but there's also the development of those captives over 1, 2, 3, and 4 years. So there's that longer payout period for some claims, which gives me a bit of a time cushion from the captive perspective.
Couldn't you structure the captive to create that cushion, right? So, and maybe instead of taking the bigger chunk, you say, well, that's ultimately the chunk that I want. So I'm going to slowly build up to that. So if the windstorm does come, I can kind of balance that because I
Mm-hmm.
view something like workers' comp, or I don't know, on when captives, when auto is put into the captive, do they put the auto liability as well?
It depends upon the structure of the claims. Again, for the captive on the primary three lines, what we're looking for is frequency claims. So if a specific insured has lots of auto liability frequency claims, but they're predictable, then yeah, we'll put them in the captive. There we get into the specific nature of underwriting for the specific account.
Yeah, because I'm thinking, a comp claim could have a death, right?
Mm-hmm.
And in some states, that's $1 million minimum,
Yep.
right? Auto could have potential like nuclear verdict
Sure.
on liability side. So as a property professional, I'm like, yeah, I can see the windstorm being problematic, but I could also see the comp and the auto also being problematic as well. It seems manageable, is what I'm asking.
I would ultimately agree with you on that one. Um, right now in the captive world, because of the increasing interest in first of all, in coming up with a solution for property coverage, there are a lot of captive people that are asking questions about underwriting property and talking to people like you about coming up with a structure that works. Um, that specific idea, the idea of building up a pool in the captive so that in the first year, maybe you can only handle a small claim, but the idea is to build up to five, six, to be able to pay the big claim in 5, 6, or 7 years. That idea is gaining a fair amount of traction. And the sole reason why is that the property market, right now is so challenging and so difficult. The other issue is that there's a subset of people in the captive world, myself included with this one, where my own personal belief is that a decent swath of property coverage within the next 5 or 10 years is only going to be covered basically by some kind of government insurance program. In my opinion,
Yeah.
coastal property, especially, say within 150, 200 miles of the coast, frankly, I could see was 2024. I could see by 2035, the commercial market saying, yeah, guess what? If you're within 100 miles of the coast, we just don't touch it. And that becomes the attitude of the insurance business.
And that's kind of the way I see it, Hale. That, like, to me, it's
Mm-hmm.
like I know everybody wants perfect scenario. Maybe we don't have it, but I think the property market, especially in catastrophes, has structurally changed.
I'd agree with that.
Yeah. I
Yeah.
think we're going to see, for example, where I live here in Florida, I've been pounding the table that now it's personal lines, but I'm sure this carries over to commercial lines as well, that a lot of the business that went from admitted to E&S, it's not going to
Mm-hmm.
go back to admitted. Like the
No.
market has structurally changed. And so I foresee from a catastrophe standpoint, with all of the models and the analytics that are available, these carriers are really sharpening the saw
Mm-hmm.
around what it is that they want to take. And so, yes, you could have coverage now, but it could disappear as well. Or you might still be able to get the coverage, but it could just be like unusually expensive as
Mm-hmm.
well. So I'm almost advising or trying to persuade, like, get some property in that captive just so you have it set up so that
Mm-hmm.
if the market continues to go awry, you have the facility in place so you're not scrambling at the very end trying to build up like a 5 year cushion. You already got the
Mm-hmm.
cushion in place. You can always come backwards, but you can't speed up 5 years unless you get on a rocket ship and go the speed of light. It's not happening, right? So
um,
it seems to me it's almost like a prudent thing to do to get
mm-hmm.
some property into the program and take a little bit more control of it because it
Mhm.
could go off rails.
I would phrase that, but in a different way, which is the fact that, again, going back to my basic argument, which is that coastal properties gone, and or
Mhm.
wildfire properties gone within 10 years. So you're forced to come up with some kind of solution. Um, I would also add two additional things that have to happen. One is that the financing section of anybody that does commercial real estate financing, and specifically here that you are a real estate partnership and you buy commercial property, and there's a whole investment structure built around commercial property, right? That model has to change. And that it used to be for a commercial real estate investor that, okay, we have insurance, it's going to be pricey, but ultimately we can transfer most of the risk to a third party and we just kind of put up with it, right? That's kind of now from their perspective, I think that they're going to have to change their basic financing model, which is that now going forward on the income statement, on the balance sheet, we, the real estate partnership, have more risk on our balance sheet. And that's just because the market's forcing us to do it. And we have to work that into our basic model. Okay. The second thing that has to happen is that banks, especially anybody that finances commercial transactions, I think they're going to have to get away from the fact that you have to have the total value of the underlying property covered. First of all, the way most buildings are built now, they're built to withstand huge strikes. So they're built to withstand Cat 5. Okay. So yes, they will experience property damage, but they're not going to collapse. Okay. So the banks that finance these deals are going to have to accept the fact that they're probably not going to be able to get the entire insured value of the property underwritten.
Yeah.
And they're going to have to change the way they finance and the way they structure a deal and how they think about this. Because, you know, the only way that a building is going to collapse now is if Godzilla emerges from the ocean and rampages through a downtown. You know,
Yeah.
so I mean, here's an example. I live in Houston, Texas. 15 years ago, Hurricane Ike came through. That was a Cat 4, and that hit, if I remember correctly, it hit Houston pretty directly.
Yep.
Downtown, a lot of windows were blown
Yep.
out, and there was some damage, but nothing collapsed.
Yep.
So I think that those two things are also going to have to fundamentally change. Now, I don't have any power over either of those, but I think I think the commercial real estate market is going to have to change in some pretty profound ways going forward because of this issue.
Yeah, I saw a social media post this morning from an insurance professional who started her own brokerage.
Mm-hmm.
She's in commercial real estate, and she specifically said she did that because the that insurance is one of the biggest expenses now
Mm-hmm.
for these firms,
Mm-hmm.
and there needs to be more and this is someone that has brought up the word captive, so there needs to be more done to kind of contain those costs. So listen, if you don't insure it, you're retaining the risk on it, so it's balance sheet risk.
Yep.
If you transfer it to a third party, it's now really expensive. So how do you explain that to your investors,
Mm-hmm.
why this expense keeps going up? So it is that tool that can be used. The banking thing is really interesting because I don't understand financing enough to understand the bank's perspective. But once a portfolio gets to a particular size, the
Mm-hmm.
probability that every single property is going to have full loss is almost zero,
Zero. Yeah.
right? And so there is a portfolio aspect to that. I wish that they would, um, I would, take advantage of. But you know, what companies are best what companies should be thinking about captives? Because it's not for everybody.
No.
I
No. No. No.
I preach all the time that, you talked about a companies that like are have risk management in
Mm-hmm.
place. So they're not just saying, well, we formed our own insurance company, we just dump everything into there and kind of go with it. No, they don't want the loss. and they
Mm-mm.
want to manage it properly. So managing the whole way. Not all companies think that way. What companies are best set up to be thinking about, yes, we should be forming a captive. We have the right ethos.
This gets to a big benefit of captives. Okay. And here's the way I explain one way I explain this concept to people is talking with somebody. I say, okay, how do you come up with the price for your product? So if I'm talking to a manufacturer, well, it's cost of goods sold plus an accepted margin.
Yep.
If it's a lawyer, it's hourly billing. But everybody has a good understanding, pardon me, of how they charge for their product in the marketplace. So then I say, okay, how does the insurance company figure out your insurance premium? I get this blank stare, right? If they don't know. So a big benefit of a captive is that as part of the underwriting process, the curtain gets pulled back on how insurance is priced, right?
Yep.
So what I look for, and what everybody in this business looks for, is people who are better than industry risks. Now, the way I explain that to people is this, okay? Insurance is a weird product because it's priced prospectively, okay? When you submit your underwriting application to an underwriter, the insurance company says, in the next 12 months, I think you're going to cost me X. Now, they have lots of formulas for that, but ultimately it's their best guesstimate of what you're
Mhm.
going to cost me. Okay. So if we look at the insurance premium, a general rule of thumb I use is that 50% of any P&C premium is the loss pick. That's the total dollar amount of claims that the insurance company thinks you're going to file in the next 12 months. Another 45% is going to be the expenses. And then there's some money on top of that. So let's suppose that for your workers' comp, the insurance company says we're going to charge you $1,000,000. What they're really saying is that in the next 12 months, you're going to file $500,000 worth of claims. You're going to processing those claims and running our business is 40 to 45%, and then there's some money on top of it, right? There's a little margin built into that. So the first thing I do is I look for companies. I say, okay, what did you pay for insurance in the last 5 years? Well, it was X. Ballpark figure, what did you file in claims? Well, first of all, typically they don't know, so they have to go back and get loss runs, which is, first of all, it might from where I sit, very revealing. But then just do a basic back of the envelope calculation, okay? Claims relative to premiums. At that point, as the English say, the proof is in the pudding. If for the last 5 years their claims relative to premium has been low, and again, use that 50%, just to get a rule of thumb. And that's all it is, right? This is before we get into any specific underwriting. At that point, the fact that they have fewer claims, that tells me that they've got risk management. Okay. And the reason why is that they just haven't filed a large enough dollar claim to go over it, right? At that point, I go back to them and say, okay, here's the deal. Your claims are really, really good. Let's take a look at this. Okay. So to answer this very long-winded explanation of your question, I look for companies that have a good claims history relative to the industry in which in which they are, and relative to premium that they've paid.
Yeah. I always, when I'm explaining captives to people, I always bring up like FedEx or
Mm-hmm.
UPS and just talk about, you see all those trucks, right? Like those drivers get training, right? Like
Mm-hmm.
there's a risk management program in place that's vetting the drivers, training the drivers, retraining the drivers,
Mm-hmm.
and even I believe software as they're guiding through their routes that's
Yep.
minimizing the number of left-hand turns, not at light signals,
Yep.
right? Where a lot of accidents occur. So, like when those firms do not want to be rated as average because they know
Nope.
they're not average. They know they're far superior to that. And to me, it's like I think you need to have both of
Mm-hmm.
you need to have good claims history, and that could be
Mm-hmm.
from good fortune or something else, but basically a documented and formal risk management program. And hell, I almost think like this ethos of I'll call it snobbishness. Like we're not the average company. We care.
No.
We don't we would prefer not to have a lawsuit, a slip and fall, a worker injured, a car accident. We just prefer not to have that at all if possible. We know it's going to happen, but we want to control and minimize and prevent.
First of all, I'm all for snobbishness. I'm all for a company that touts their safety record. Okay, first of all, think about it this way, right? Let's suppose that you're a company and you're about to sign a contract with another company, and they come to you and they have a snobbish attitude about our risk management. And suppose in this fact pattern that delivery of product from point A to point B is a key component of the
Mhm.
transaction that you're about to do. If a guy comes up to you and says, you know what, our company has a loss ratio lower than 20, that's 20% lower than industry average, dude, you're going to sign it. You will happily sign that contract, right? Because the possibility of supply chain disruption is now dropped. Okay. So I want snobbishness. I want somebody that's cocky about risk management. I want somebody that says, my name is Joe Smith. I'm the CEO. This is Ed. Ed's my safety guy. Ed has complete carte blanche over the practices and protocols that exist in my company.
Yep.
And as a result, we have a great claims history. Short version, I want to see Ed there. And I want the company to like Ed. I want Ed to get bonus for having a good safety procedure. I want Ed to have the power to implement practices and procedures, and I
Yeah.
want Ed to be a big part of it.
Wow.
Short version.
Your answer right there reminded me of 9/11.
Yeah.
I can't remember. It might have been JP Morgan. I think it was one of the banks had a risk management professional who was adamant. We will do the fire drills and we will do the emergency drills. We will do these drills. And he ended up not surviving because he was doing his risk management stuff and going back and forth. He wanted everybody out.
Out.
But almost every employee said we were not stressed out because we had done this so many times.
Uh-huh.
And it's like that level, we'll keep using the word snobbishness. I'm sure there's a much better word for it. But that level of responsibility
Mm-hmm.
is, man, if you're a corporation and you think that way, you have to have a
Mm-hmm.
captive, right? Like,
Oh
no,
God, yes.
I mean, there might be a mutual, like, maybe a mutual insurer where you're getting together with other like-minded firms, sort of like how the way FM Global kind of grew. Like, oh, we're not
Mm-hmm.
like those other factories. We try to prevent fires, but in a way, like those mutuals were captives. And they
Mm-hmm.
were like early
Yeah.
versions of those captives. So that kind of ethos exists, and those firms really can reduce insurance expense, reduce balance sheet risk. It creates to me, Hale, it creates an economic benefit that's significant for that
Sure.
firm in the long run.
It used to be that, and just to get general timeline here, late 50s, early 60s, if you were the risk manager for any company, at that time there were two things you did: buy insurance and process claims. That's what you did.
Mhm.
That's what your section of the company did. Fast forward now 40, 50 years. A good risk manager is a much more nuanced, complex job
Yeah.
where not only are you looking at standard insurance risks, but you're looking at marketplace risks. You're looking at strategic risks. You're qualifying things that can go wrong. You're quantifying that the probability that they're going to happen, the
Yeah.
cost if they happen. Like suppose you're a company and you're part of the international supply chain, right? Well, with the increase of typhoons in the Pacific, if you have a delivery chain from China, across the United States, the possibility of your inventory being having a problem with your inventory because of those typhoons delaying your supply chain, it's higher. Okay, so what is the probability that this typhoon hits and our 2 week delivery time from Hong Kong is now 3.5 weeks? What does that mean for our inventory, for our holiday? I mean, this is what risk professionals do.
Yeah. That's not even a hypothetical. Go back
No.
to the early part of the prior decade, the Thai
Mm-hmm.
floods. We
Yep.
saw that.
Mm-hmm.
So Thai floods came. There was unusual number of concentration of semiconductor companies who were relying on one or two Thai firms that were
Mm-hmm.
devastated by those floods, and iPhones got delayed. computer parts got delayed. There was, and I don't remember what the part was. It's something to do with
Yeah.
semiconductors, but there was a delay and it screwed up everybody's supply chain. And Hale, that's where I get really excited about the captive area
Uh-huh.
because if you do your homework and you identify that choke point, you can ensure that. Like you could hire
Yep.
someone like me to do the catastrophe modeling to
Yep.
determine what the loss pick and what the PMLs are going to be for something like that, and you can begin to fund it ahead of time.
Yep.
That is incredibly difficult to get market coverage for,
Mhm.
especially after it happens. That almost every insurance company is like, no way.
Well,
We didn't even know you guys had this concentration problem.
also in your case, in the fact pattern you just outlined, you can make it company specific.
Yeah,
So suppose
yeah,
suppose that you're dealing with this port, right? And this port has a 20% a higher 20% higher probability of being hit by a typhoon in the last 10 years. You can incorporate that into your model
yep,
and price for it and insure it and come up with some kind of plan to deal with the negative ramifications of that event.
yeah.
Huge deal.
Especially in this day and age, Hale, with all of the technology that's been developed in in the last few years with insurtech, but
Mm-hmm.
you can go back a couple decades now with catastrophe models. Like the analytics are so good that
Mm-hmm.
yeah, there was a period of time where you wanted to combine forces, you wanted to share data so you could have a bit more statistical confidence in
Mm-hmm.
your projections.
Yeah.
But now it's so good. It's still portfolios are still going to reduce uncertainty around that, but you can create models now that can
Mm-hmm.
be very hyper focused, very geospatially centric,
Mm-hmm.
really isolate your building, your customer, your supply chain, and
Mm-hmm.
model out different financial scenarios of like, okay, what if that chip maker goes out of business? What if China invades Taiwan?
Yeah.
Sort of thing. Like, oh my God, like not only are we going to lose our chips, but it could be World War III sort of thing. You can model those things,
Mm-hmm.
and it's not perfect. You're going to have an expected loss with a very large variance, but you might be able to compute something that's more attuned to your risk than your insurance company, who's not really thinking about you that specifically. Like you said, it's top down. They're looking at the average and then
Yeah.
trying to gauge with credits and debits um, how you might drift outside the average, but they're not going to allow you to go too far outside the average.
Going back to all the math ideas that you just mentioned, something that's really important here is that is to accept the following. The numbers I come up with are not perfect. Okay, you have to understand that. But what is important is that you're talking about it. So going back to this scenario of China invading Taiwan, if we do business with Taiwan, we have to understand that a strategic risk
Yep.
is China invading. Okay, so what would happen to our business model if that happened? Okay, so and at bare minimum, you're talking about it. And then by assigning some numbers to it, you're kind of figuring out the negative ramifications and the negative implications of that event. And then if the pain threshold is high enough, okay, if this happens, we lose 80% of our supply. I think we need to find something else. And for no other
Yeah.
reason than if this happens, we're out of business or our company is so compromised that we're going to spend 18 months scrambling.
Yeah.
Let's avoid that and come up with a new way of getting this specific product. So,
Yeah.
and that's a key issue there. It opens the discussion to the what ifs.
So that's another great segue to property again,
Mm-hmm.
because property includes a lot of things, including business income. And
Mm-hmm.
I'm thinking, if you're a hotel chain that has hotels in the Caribbean, right?
Yeah,
Okay, I heard horror stories
sure.
around business interruption and
Mm-hmm.
BI. I think everybody hates it. Everybody. The client hates it. They hate filling out the worksheet. The broker hates being the liaison in between. And the underwriters, quite honestly, they just collect the worksheet. They're not sure if those worksheets are true. Business interruption in property cat is almost inevitably going to invite forensic accounting, right?
Oh God,
And
yeah.
I knew a situation of a hotel in Puerto Rico. It was a hotel and maybe a pharmaceutical company where the forensic accountant spent a good 12 months
Mhm.
adjudicating the accounting. The forensic accounting was more than the limit that they were paying. And I was like, it took over 12 months to get made whole, whatever that is. I almost see business interruption as that use case where it's like, don't rely on your insurance company. It could take forever. By the time even if you are made whole, you could be out of business, right? Waiting for that check. Don't do that. Like that is one right there that's like
Mhm.
between uh between the ability to model it and also the ability to use like things like parametric coverages as well. It's completely set up for you to grab the bull by the horns and just
Mhm.
say, we cannot afford to wait months and months and months for indemnity on this. You can take a lot more control over it, and you could even change it up. You could do, like I said, you could do parametric, but you could do, instead of loss of income, you could do
Mhm.
loss of revenue and make it
Yeah.
real easy and just say, we were closed. Here's the amount of business we lost. Here's the
Boom.
indemnification for that, to make it really easy instead of this convoluted years of forensic accounting to try to get made whole. It seems like that's a good use case.
Oh, it's a huge. First of all, I think you might have missed this, but I just stepped up on a soapbox. So just FYI.
Okay. You
Oh,
look
okay.
taller. I'm going to get
Yeah.
down.
Okay. On business income. Okay. First of all, business income in the property policy, it requires property damage to be triggered.
Yes.
So there has to be physical damage to your property for you to file a business income, to file and get paid on a business income claim. This was a huge issue in COVID. A number of businesses closed and they looked at their property policy and they saw business income. So they filed a claim.
Yep.
All the claims are denied. And the reason why is there was no property damage. So there's some ensuing litigation about whether or not the COVID shutdown caused quote unquote property damage, as that term is defined in the policy. To my knowledge, universally, all those claims were denied. Okay. I could be wrong on that one, but
I
it's the
think
bottom line.
I think there were a handful that might have been able to go through, but the
Yeah.
bar was very high, Hale. Like they actually had to show things like there was actually they detected the virus in the building kind of thing.
Yeah. So, okay. So there's that issue. There's that issue for business interruption. Here's a second issue. Look at the exclusions in your policy. A favorite one of mine is the utility exclusion. Okay.
Yeah.
So if you read your property policy, sometimes there's an exclusion there that if your business income is caused by power interruption that occurs off site, then the amount of income is capped to like 25 to a specific dollar amount for that specific policy. Now, I'm in Houston. Hurricane Beryl just came through. We are still dealing with power restoration issues.
Yep.
I drove along 610. There's a very popular Starbucks. Power is still off because they have what's called a nested outage, meaning that there's like 5 buildings. They're tied to a transformer that blew or something like that. So they would like to be reimbursed for their lost income. They're probably not going to be able to get it, or if they file the claim, there's going to they most likely have that utility exclusion in there where the insurer says, you know what, I'm really sorry that you lost, $125,000, but all we can pay you is 15 because that's what the exclusion says. So
I,
yeah,
it's a Starbucks. So
yeah,
technically, they need to account for how much additional business other Starbucks around that area got if it's the same franchise,
oh
right?
yeah,
Like, did they just go to the one down the street and that made up for it and you're fine, kind of thing? It's like it's business interruption is really messy, and we can go use case after use case, and this is why I think like the captives are just really useful. If you have a commercial property that's on an island and
Hmm.
the bridge washes away,
Oh, there you go. There is a great example right there.
you can
Yeah.
model the bridge. You
Yeah.
know how I know? Because I've modeled bridges for flood. So you can model the bridge. You can put an expected loss on that. I'm thinking of I remember being in a meeting with Disney years and years ago where Disney has a risk management team. I was meeting with the risk management team. They were not concerned about Disney, the property. They were concerned about Orlando International Airport. They were worried that the
Yeah.
airport would get significantly damaged in a hurricane and guests would not come
Yeah.
there. Right. And so, like those kinds of things, ports, airports, those are
Hmm.
all things that can be modeled in a loss pick in a PML
Yeah.
can be forecast for that. And so you can provide some coverage for yourself for the things that are excluded or are messy.
And that goes back to an earlier discussion, a point that has popped up a couple of times in this conversation, which is it's the idea of thinking these things through. Okay, so Disney, they have this giant property in Florida, and what they're worried about is not the property, probably because they've already talked to all the construction people, and the construction people are like, dude, again, barring Godzilla coming out of the
Yeah.
ocean. I'm comfortable but what they're worried about is the flow of tourists into their facility.
Yeah.
So what does that mean? Travel
Yeah.
yeah,
They,
it's a
they
huge
didn't
hit.
have a hard property risk. They had a
It was a
soft
soft.
property risk. They had a business
Yeah.
income. They were more worried about the business income than they were actually worried about the actual physical property. And
Again,
there are a
makes
lot of
perfect
firms
sense.
like that. Like you said, in Houston, in Florida, like skyscrapers are engineered to withstand category 5
Yeah.
hurricanes, right? Skyscrapers in Los Angeles and San
Yeah.
Francisco are engineered to withstand like magnitude 8 earthquakes. Like
Yeah.
they're built for that. And if commercial real estate was a problem for natural catastrophes, there would be no city of Tokyo,
Yeah. Exactly.
which is
Yeah.
like the worst place in the world.
Yeah. Which is like what, 20 million people now?
Yeah.
I mean, it's one of
20 million people in a
it's one of the
really
five
tight,
largest cities. Yeah.
concentrated area, right? With significant hurricane, typhoon exposure, like significant typhoon exposure,
And earthquake.
and subduction zone, significant earthquake
Yeah.
exposure, right? We
Boy,
won't
that's
we
a good
we
point.
won't we won't talk about atomic bomb exposure. That's not even funny. I'm sorry. So it the when engineering and architecture gets put in place, I think you can have strong
Hmm.
confidence.
Yeah.
I think you should put in a fudge factor of like, okay, 0.5%. What if we're wrong? What if the building collapses? Make it consequential, but I think it works that way. I would like to end this,
Sure.
Hale, with spread of risk and
Well, risk distribution.
distribution because we just talked about like specific scenarios, and I think there is an issue with things like the IRS saying you
Uh-huh.
don't have appropriate spread of risk. You're not a real insurance company. How should companies be thinking about spread of risk, especially if they're not big and especially if they're not like a Hilton hotel franchise all over the country?
Okay. Risk distribution is this concept. And okay, I just wrote an article on this with an actuary named Gordon Thompson. Okay. And here's what happened. Risk distribution, that phrase popped up in the tax law about captive insurance companies in a case called Hellring v. Legiers. And ever since I read that case, the ideas flowed through the captive insurance cases, right? And by the way, it's the big issue of controversy between the IRS and taxpayers. What is risk distribution? You have to have risk distribution. What is it? Yeah, no one really quite knows, right? So what I did starting about a year ago was to go back and shepherdize the concept of risk distribution. Now, to a lawyer, what that means is that I go back to the beginning of recorded legal time, find the first instance when this idea is mentioned in the case, and then I trace it through all the decisions, right? So the first judge says risk distribution is X. Second judge says, okay, yeah, it's X, but it's also Y. Third judge says, yeah, I don't think it's so much X, but maybe think about it. Anyway, there's basically this long conversation that occurs in decisions. And
Hmm.
eventually the courts coalesce around an idea. So, in addition to going back and doing a legal shepherdization of the concept, I wound up doing an insurance academia shepherdization. That is, that the idea of spreading risk was also part of the insurance academic literature going back to the early 20th century. So I traced that idea. Interesting thing happens. In the 1950s, actually from the late 50s, early 70s, the insurance world comes up with a different understanding than the tax court world. Okay. But here's the problem: the insurance world concept of risk distribution, it's different enough to where if I comply with what I call insurance world captive or IWC, I may not comply with tax court captive,
Hmm.
TCC. Okay. So here's what the issue is. Okay. In the tax court decisions, there are 4 or 5 decisions that have a very brief paragraph. Risk distribution triggers the law of large numbers. And the idea being that an insurer gains, or they insure so many risks that they can more accurately predict the claims that are going to come in, and hence they can more accurately price insurance. That's kind of, in general, the idea that the tax court is expressing. The problem is the law of large numbers doesn't really work that way
Yeah.
with insurance. Okay. And this is what the insurance world figures out. Again, late 50s, early 1970s is this time period when it doesn't really work that way. What the insurance world does is instead is they look at the portfolio of risk. I'm an insurance company. I'm insuring 500 manufacturers. Okay. I need to understand my portfolio of risk. So they do an analysis of it, and they look at claims, and they look at frequency and severity of claims, and they come up with idea. They come up with specific values for certain things that they look at. So going for risk. So short version, how do we deal with this? Especially when we have this really weird split where the tax court says you got to have law of large numbers, which in reality doesn't really work very well for the insurance world. How do we deal with this? Well, we have a couple of ideas from IRS cases, pronouncements, and case law. One, in order to have risk distribution, a big thing they look for is claims. The IRS firmly believes that risk distribution is tied to some kind of claims volume, that I am paying a large number of claims relative to my risk. I also need to ensure enough what are called statistically independent risk exposures. So what are these? Well, again, we have this really weird split because in the insurance world, an exposure is gross revenue, payroll for workers' compensation, power units for auto. In the tax court cases, instead, they look at the number of stores that I have, the number of employees individually, that kind of thing. So to wrap all this up with a bow, I'm going to give you a very lawyerly answer. Risk distribution, as the tax court understands it, is an ephemeral concept. Okay. If the IRS comes in and audits you and they say you're not an insurance company, you're going to have to fight it out. And you're going to have to get to tax court to fight it out because that's where the real conflict occurs in tax conflict. Okay. So what can you do? One, have an actuary come in and opine on the existence or not thereof of risk distribution.
Another independent actuary,
Yeah.
like a third party.
Yep. And what you want there is a good actuary. They just say, look, I need a risk distribution opinion. They know exactly what you're talking about. Yeah. It's like, okay, been here, done that. Got the t-shirt, right? But you want a third party to come in and explain the concept and write it out for you. Short version, you want a third party to come in and issue at least an informal opinion that you have something related to risk distribution. And also realize this. For the last 70 years, the IRS has expressed abject hostility towards captive insurance. Yeah. Okay. They don't like it. They have never liked it. I seriously doubt they will ever like it in my lifetime. in their public announcements, they will say something to the effect of, "While there are some structures that are legitimate, whatever," and basically it's their way of saying, their way of conceding ground that they kind of feel they need to concede rhetorically, but they don't like it. Okay, so realize that if the IRS gets involved, the probability of a fight exists, and it's not a small probability,
Yeah.
and that's just the way it is.
I almost feel like if you have that risk management ethos that we were talking about, this is part of the risk management as well,
Oh, without
right?
doubt.
And you know what? You're probably already doing aggressive tax management if you have that ethos
Yeah.
anyways. So,
Mm-hmm.
Hale, this was an awesome conversation. I picked up this book on Amazon. I'm sure it's probably available anywhere fine books are sold.
Actually, no, it's only available on Amazon.
Okay.
I think that's basically because all book companies are now Amazon. I think that's kind of happened. So FYI. So so you have to go through Amazon.
How did that get
So
through antitrust? Who knows?
that's boy, that's another conversation.
That's another conversation. Hale, very much appreciated. Thank you so much.
I appreciate it, Nick. Take care.
Okay.
Bye bye.